Ali Abdaal's investing guide. So close, but not quite it. With millions of views, Ali Abdaal's investing guide, How to Invest for Beginners 2026, seems like the ideal gateway into investing. Polished, warm, and clear in its first principles. It's the kind of video that makes people feel like they can finally get a handle on a topic that once felt so intimidating. The pacing is deliberate, and the tone is that perfect mix of reassuring and aspirational. He speaks like the friendly older brother, explaining how to set up a plan and why you don't need to gamble on single stocks to build wealth. For most viewers, that alone is a huge service. And yet, for all the production value and poise, something in the structure of his argument quietly unravels. Beneath the approachable surface, there is a tension, an almost dreamlike dissonance between what is being taught and what's ultimately prescribed. It's as if the message drifts into a fever dream, where calm, evidence-based reasoning is thrown out the window. That part of what makes the critique of Ali's investing guide so interesting. He manages to wrap this complex financial topic into a short, approachable video, and still ends up turning the wrong corner a few meters before the finish line. Something that seems to happen to a lot of influencers. I'm not quite sure yet why that is. And in many ways, Ali offers a refreshing contrast to the aggressive, hype-driven tone of many other YouTubers. You don't notice the cracks in his logic right away, but once you do, it's hard to look past. We will explore the drift later in detail. For now, let's focus on the positives and acknowledge what Ali got right, before it all comes crashing down again. Why I went looking for a YouTuber's beginner's guide in the first place. I stumbled upon Ali's investing guide because books, even the excellent ones, often don't land for beginners. For German speakers, I usually recommend Gerd Kommers Souverän investieren for English speakers. And for English speakers, A Random Walk Down Wall Street. Both offer incredible value, but I have not met anyone yet who actually commits to reading them. So I went hunting for an accessible YouTube starting point. Ali's new investing guide was published on February 26, 2023. Its title, I've noticed, has since been updating its year, 2025 to 2026, and it has racked up nearly 3.5 million views by the end of 2025. He also has an older guide from October 11, 2020. In other words, he's had time to think about this topic, iterate and refine his message. And the title name suggests Ali himself or his team have verified its continued accuracy in the following years. Unfortunately, Ali's advice had not been 100% accurate from the day he hit publish, and I wonder who is asserting every year in the YouTube Studio tab that this guide will still do for yet another year. What Ali gets right and why that matters. Ali nails many of the things I want in a beginner-friendly investing guide. Presentation and clarity. The production quality and pacing are excellent. His explanations are beginner-friendly without being condescending. ETFs over stock picking. He emphasizes passive investing. Great. For new investors and investors in general, avoiding individual stock bets is a huge win. Calling out gurus. He opens by calling out the usual hype merchants right at the start of his video. A clear signal that his guide aims to be different. Good start. S&Me. I also like his S&Me point he makes later. Building skills, career capital, and side projects can move the needle more than obsessing over ETF ticker symbols. For most people, income growth beats micro-optimizing asset allocation. That is a healthy message, even if I think it takes a little bit too much time in his guide. But of course, Ali is leading up to the inevitable plug for his YouTuber part-time academy. It's the aspect Ali has the most hands-on experience in, and therefore it is logical that it makes out a major part in his investing guide, though. I also believe Ali tries to give honest advice. He's done the investing research for himself and his audience, and when he recommends something illogical, it's not about bad motives. He's recommending what he is also doing himself. That authenticity is a big part of why beginners trust him. The pivot point: S&P 500 versus a diversified ETF. Here's where the logic wobbles. After explaining why investors shouldn't pick individual stocks, Ali effectively recommends picking a single country, the S&P 500, or alternatively another diversified ETF. The S&P 500 is big and liquid, but it's US only and heavily tilted to a handful of sectors. If your principles are don't concentrate your bets, prefer broad rule-based exposure, then the natural extension is a global diversification, not a US-only portfolio. This isn't about dunking on the US market. It's about internal consistency. If you don't believe you can outguess which company will win, why would you bet your entire core portfolio on one country winning? That's just stock picking zoomed out one level. A quick thought experiment. Imagine you're teaching a friend to avoid concentration risk. You say don't buy a single stock, buy a basket of thousands across sectors and regions. They nod. Then you say, now put everything into one country that I think looks the strongest right now. They would look confused, and rightly so. The principle you just taught points to owning the world, not making a macro bet on a single economy. The unspoken conundrum. If diversification is the only free lunch on Wall Street, why does the default quietly jump to the largest 500 US companies? I will be honest, I expected more from Ali. With a Cambridge medical education and a YouTube brand built on learning how to learn, critical thinking, and productive habits, a doctor building a YouTube empire part-time, I at least thought he would spare a sentence or two on this paradox. Maybe I'm being unfair, but is it wrong to expect that level of detail from Ali? It's an especially curious contradiction given Ali's international background. Born in Pakistan, educated and trained in the UK, and now based in Hong Kong. He's lived across multiple regions and cultures. For some US YouTubers, I might just believe the world seems to end at the US border control. But Ali's background should intuitively align with the diversified, worldwide investing mindset. Yet in his guide, the world economy boils down to only the 500 largest US stocks. Why global diversification is the cleanest implementation of the beginner rulebook. A truly global fund, for example the Vanguard FTSE All-World, holds thousands of companies across the US, Europe, Asia, and emerging markets, and around the world. That better aligns with the beginner's rulebook Ali lays out. Don't try to outguess which country or sector will win next. Benefits of a world ETF as the default core holding. First, fewer hidden bets. You're not secretly leaning on US tech dominance, a strong dollar, or a specific policy regime. You own whatever the global market owns, in proportion. Second, sector rotation protection. Leadership rotates. The 1980s loved Japan, the 2000s rewarded emerging markets and commodities, the 2010s to 2020s supercharged US tech. Owning the world removes the need to predict those cycles. And third, behavioral simplicity. With a global default, you're less tempted to upgrade by adding tactical tilts every time headlines change. That alone can protect returns. Yes, the S&P 500 has dominated recently, but that's recency bias. The beginner safe takeaway should be own the world. Accept that leadership rotates and let rebalancing and market weights do the heavy lifting. What I wish the guide had said. I like the S&P 500, it's what I use. But if you're optimizing for principal diversification, a global ETF like FTSE All-World is the default. Costs differ a bit, but for most beginners, the risk reduction from global exposure outweighs a few basis points. But I think many investors, and probably Ali as well, would still end up choosing the S&P 500. I do believe private investors deserve to know the cleanest scientific way to invest before getting head over heels into specific country bets. While Ali does technically suggest a broadly diversified ETF, I think many beginners will come away from this video thinking S&P 500 it is, without knowing there are better options out there. The impression the video gives, that it is a comprehensive starting point for beginners, doesn't help either. It's okay to not know everything. It's the same for me, even though finance is my main focus, compared to Ali, who mostly focuses on productivity. But if you are pretty much a beginner in the field yourself, maybe it's not the best idea to position yourself as an expert. I think your audience deserves to know. And it also begs the question why someone who even watches anime productively was not able to productively read some scientific books and papers before putting out this rather definitive looking guide. But Buffett says S&P 500. Warren Buffett's often quoted just by the S&P 500 advice, which all Ali also includes in a clip in his guide, is simple and well meant. But it also comes from someone who is now well into his 90s. A man whose investing worldview was forged in a completely different era of markets. Buffett made his fortune in American businesses and has openly avoided high-tech bets because he only wants to invest in concepts he fully understands. Sensible for him, not a universal law. For beginners who are not looking for a strong intentional US tilt, a world ETF is the more consistent choice with the don't pick winners principle. The case Ali could have made but didn't. Ali could have made a reasonable case for favoring the S&P 500 by pointing out that Vanguard's S&P 500 ETF has a lower total expense ratio than Vanguard's FTSE All-World ETF. That would at least give some internal logic to his argument. A clear trade-off between cost and diversification. I would still disagree with him, because I think the diversification benefit outweighs the additional marginal cost. But it would have shown a coherent rationale instead of leaving attentive viewers puzzled. A quick data sanity check you can do. If you scan these specific funds on just ETF, Vanguard's S&P 500 ETF and Vanguard's FTSE All-World ETF, you will notice that the FTSE All-World Fund typically shows lower volatility over many periods and slightly better risk-adjusted returns. Of course, short-term time horizons will not statistically be significant, but following the passive investing principles, this is exactly what you would expect to see. More diversification equals a smoother ride over time. That's exactly the logic which led us to choose ETFs over stock picking in the first place. The S&P 500 already owns the world's best companies. Many world-leading firms are indeed US listed, and the global fund remains heavily weighted to the US anyway. But a 100% S&P 500 portfolio still omits meaningful non-US exposure. Small, mid-caps abroad, regional champions, different policy and currency regimes. Global ownership reduces idiosyncratic country risk without sacrificing any simplicity. And if you look at the Just ETF website to compare the Vanguard S&P 500 distributing to the Vanguard FTSE All-World distributing, we can see that the S&P has a lower cost of 0.07%. And the FTSE All-World, because it invests into more and smaller companies, has a higher cost of 0.19. The volatility for 5 years is the S&P is higher with 17.89%, and the FTSE All-World lower with 13.74%. And then looking at the return per risk for 3 years, again the S&P with 0.93 and the All-World with 1.12. And again for the return per risk for the 5 years, we have the S&P with 0.87 and the All-World with 0.94. And then maximum drawdown for 5 years, the S&P has minus 23.74 and the All-World has minus 19.459. So again, lower. and then the maximum drawdown maximum over the entire time period. Again, it's very close, but the all world is better in that regard too. The S&P has minus 33.7%, and the all world has minus 33.47%. Sponsorship and incentives. Trading 212. Ali's video is sponsored by Trading 212, and some of his recent videos are too. It's a logical partnership for a beginner's investing guide like this. And you can absolutely buy global ETFs on Trading 212 as well. Still, keep in mind that active trading features, copy trading, etc., Ali talks about in his sponsored segment are profit centers for brokers. If anything, the evidence says the opposite. Keep trades rare. It reminded me of how Linus Tech Tips sometimes explains why building your own PC is cheaper and better, then immediately cuts to an ad for a pre-built PC company. The contrast isn't malicious, it's just the byproduct of sponsorship economics and the simple reality that some customers are willing to pay for convenience or extra features, even if they don't really need to. A brief aside, the keyboard launch pattern. Hypotech's critique of Ali's keyboard launch and Ali's own follow-up conversation highlighted a pattern that feels strikingly familiar here. Shipping before the research is truly finished. The tech YouTuber pointed out how the keyboard project of Ali felt rushed and the product half-baked. Ali explained that the team had already invested significant time and money, that they were working on a back launch simultaneously, and that he was filming promotional material on a tight schedule. In short, he admitted that mistakes were made because he was stretched too thin. And to his credit, he was transparent about it afterwards. That same pattern seems to repeat itself in his investing guide. The video is beautifully shot and confidently delivered, but the underlying research feels unfinished. It's polished on the surface but rough underneath, like releasing a keyboard that no one really asked for, banking on your established social media authority instead of substance. That's why his S&P 500 default feels so frustrating. It comes across as a summary of surface-level social media wisdom rather than the grounded financial research I was hoping for. But he is not alone in his error. This is a very common pitfall many influencers fall into when they start dipping their feet into finance content. The gateway drug effect. I won't pick stocks, but I will pick the S&P 500 because the large US companies will clearly keep winning. And already we're talking specific country and company size bets. Then single stock bets. Nvidia must go up because of all the AI hype. The financial industry happily takes a fee at every step. It's a slippery slope, almost like the path Yoda warns of in Star Wars. Hype leads to FOMO, FOMO leads to chasing, chasing leads to overtrading. Overtrading leads to suffering. The antidote is principled diversification from day one. A note on risk and life stage. One thing Ali mentions, he recently started a family. Congratulations. That's exactly when it's worth reassessing risk versus goals in a structured way. Your ability to take or willingness to take risk, income stability, emergency fund, time horizon, and your willingness to take risk, sleep at night factor, drawdown tolerance, often shift the moment you have dependence. What looked reasonable when you were at the beginning of your career, effing around and finding out, might not be what you feel comfortable with once you're optimizing for reliability and resilience. And to be clear, this section and the wider critique isn't about trashing Ali. I don't expect he will even see it. It's about doing what a healthy, science-minded community should do. Stress test ideas in good faith, so everyone can form their own view and we all come out of the process a little wiser. At least that's what I hope. Concentrated equity risk feels different with a baby at home. Sequence of returns risk matters more. A deep drawdown early in your family years can change the trajectory of your plans, even if long-run averages look fine on paper. If, by his own account elsewhere, Ali runs a portfolio tilted heavily to the S&P 500 with a non-trivial slice of crypto, that's a conscious concentration bet. Nothing immoral about it, but it is a higher volatility stance. With new responsibilities, that's the perfect moment to rebalance towards calmness. Consequences of half-assing investing advice. Ali's core audience isn't a room full of hedge fund PMs. It's students, young professionals, and maybe also some new parents as well, trying to build a durable nest egg. Pointing them to a US-only core raises avoidable risks they may not recognize until it is too late. Why this matters in real life? Higher volatility, drawdowns, and sequence of returns risk compared to the more sensible world ETFs. Lower portfolio survival odds at a given withdrawal rate. For the same spending rule, higher volatility tends to lower the chance your plan survives a full retirement horizon. Global diversification generally improves the distribution of outcomes. These are consequences for people following Ali's lead that might not be reversible. If Ali were fully aware of these second-order effects, I doubt he would be proud that his default nudges creates more risk than needed for beginners. And this is fixable without making the guide more complicated. Default to a global ETF that finally makes sense. Frame the S&P 500 as an explicit tilt with pros and cons, even though I mostly see the cons, and show how to match risk with stages of lives maybe if you want to get into more detail. Why this matters for a broader brand? Recently, Ali's content leans more into side hustles and entrepreneurship, helping people start small businesses and grow income. That audience might reasonably expect a scientific solid baseline on investing, or in general, expect Ali to know what the heck he is doing. A tighter grasp of passive global diversification would be the perfect companion to his business advice. What I want from the third edition. Ali's guide is well produced and nearly there. If he does another edition, I hope he draws a clean line from don't pick stocks to also don't country pick, explicitly frames the S&P 500 as an optional US tilt, not the default, and make the default ETFs something like the MSCI All Country World Investable Index or the MSCI All Country World Index or the FTSE All World Index. And you should also ground the advice, or at least I hope so, in one or two scientifically rigorous books. Or can I dream of directly citing some relevant papers as well? In general, it would be easier to evaluate where and why Ali's reasoning went off track if he would cite his sources beyond a pre-Warren Buffett clip. But perhaps that's the issue. That might have been the extent of his research. He has the platform and the talent to make a truly gold standard beginner guide. A small tweak in the core recommendation would elevate the whole video from good start to let's frickin' go. Bottom line, Ali's intention seems good, and many of his explanations are spot on, but recommending the S&P 500 as the default is simply a beginner's error. The simple fix, FTSE All World or a similar global ETF as the default. Cut those fever team detours and keep the established principles. What do you think? Do you think the S&P 500 is good enough, or should a global ETF be the standard starting point? I would love to hear your thoughts and experiences in the comments. Did you switch from an S&P only portfolio to a world fund or vice versa? And if you're in the S&P only camp, what convinces you that the extra concentration is worth it?